Hey investors, what if I told you there's a bond-style ETF that's been dumping cash like a gas station on the freeway, but you're left with a battleground of risk? Stick around to see if that free cash flow movie is actually a thriller or a crash test. We're talking about the Wisdom Tree Alternative Income Fund, ticker HYIN. Think of it as a low-volume club that trades in the world of private credit, and above waterfall, loans, you don't find on Wall Street's lunch table. The fund rides an equal-weighted benchmark of 35 private credit vehicles and other alternative debt tools, aiming for month-by-month cash returns. It launched on May 6, 2021 and is managed by Wisdom Tree. What follows is research and education only. It isn't financial, tax, or legal advice, and it's not a recommendation to buy or sell. ETFs can lose value, and the data here may be out of date. Always read the latest prospectus and talk to a qualified professional before making decisions. On July 6, 2026, the share price sits at $14.24, a drop from the $25.39 launch reference price. The expense ratio is a hefty 4%. Assets under management are $51 million, and every month the fund distributes about 14 cents a share as its most recent payout. These numbers paint a quick picture of where the money stands. HYIN pulls its headline distribution yield from about 13% by annualizing the current month's cash flow. If you grind the monthly payment out, you get an 11% mechanical annualized figure. Most of that cash is generated through an options income play. Think of each underlying claim as a house you're leasing out. Every month you rent it out for a premium, but you'll shift the house to keep higher rents for shorter periods. The payout story hasn't been a shortage-free journey. The fund's first 4-month average payout was 38 cents a share. That's the peak of the fireworks. In the last 4 months, you're looking at only 14 cents, a clear decline. The trend shows the income stream tightening as the earnings from the underlying assets slow or the option strategy loses traction. Because VIT-DK said the NAV has slipped by 44% since inception, you must remember that the quarterly ball has turned more into a treadmill. The max drawdown reaching 47% means the foot in the door is slipping sideways, not quite the classic 12-month S-curve you've seen in safer, fixed-income tracks. The NAV peaked below its launch reference and has not been able to regain that level. If you add the cash you've received out of the bottle to the current price, the total return since launch languishes at a modest 3%. In other words, even with the monthly payments, the portfolio ends up slightly behind a simple hold-and-watch approach. HYIN sits over a basket of these alternative credit names: Oxford Lane Capital Corp., 6th Street Specialty Lending, Golub Capital BDC, Agink Investment, Ares Capital, and Hercules Capital, each taking a roughly 3–4% slice. Nobody holds large concerted positions. The entire index is pooled equally. The mechanics: the fund writes short-dated call options against this basket to harvest premium. That premium sits in the fund's coffers and is passed back to you monthly. The trade-off is clear. You cap your upside because you've already paid the premium, and if the underlying borrowing decreases, the NAV can erode. Moreover, a portion of that cash might actually be a return of capital if the fund needs to keep the price around a healthy level. 1. Elevated expense ratio of 4% will chew through a part of the yield. 2. The 47% max drawdown signals that the underlying credit risk can be unruly. 3. Options income relies on continued volatility. A quiet market might shrink the premiums. 4. The continued decline in payouts signals a potential erosion of long-term cash flows. 5. A 13% headline yield is high for a fund that gives you no full market insurance against credit defaults. HYIN delivers one of the highest headline cash yields in the bond sector, but those numbers are razor-thin when you factor in the high costs, the option house trade-offs, and the nervous turn of the payout trend. If you're a cash flow-centric player who can stomach a 47% drawdown and wishes toll-in market noise for a steady premium stream, this may be worth a look. If you prefer capital protection or a smoother, lower-risk income track, you'll probably find another venue better suited to your goals. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.